We at Anand Rathi are pleased to host the Q1 FY19 results conference call for HTmedia and HMBS. So we have the senior management team of HTmedia Group. I would now like to invite Ms. Anna Abraham, Head Investor Relations and Financial Planning and Strategy, to give the opening remarks. Over to you, Anna.
Thank you. Good morning, ladies and gentlemen, and thank you for joining our earnings conference call. It has been a tough quarter both on the revenue and on the newsprint cross front, which has impacted the results which we have reported for the quarter. We will be taking you through the details of the operating performance during the course of the call today. Joining me on the call is Mr. Piyush Gupta, Group CFO of HTmedia Group, Mr. Rajiv Biotra, CEO, Hindustan Media Ventures Limited, and Mr. Sandeep Gulati, CFO of Hindustan Media Ventures Limited. We will be, our remarks today will track the presentation on the webcast, which is also available on the Investor Relations section of our website. I would now like to draw your attention to the slide 2 of the presentation, which is the disclaimer relating to the forward-looking statements. Moving forward, during the course of the presentation, we will take you through the highlights and financial performance of the group for the quarter. We will cover separately the performance of print business, including English and Hindi, and the radio business in detail. Following our remarks, the call will open up for questions. With this, I hand over the call to Piyush.
Thanks, Anna. Good morning, everyone. I'll directly jump into the presentation by going over the highlights of the quarter. As you can see on slide number 6 on your presentation decks, the highlights in the print is that we launched the Hindustan Purnia edition during this quarter. This has been in work for some time, and finally, in this quarter it has been launched. However, as you've seen in the financials, which we will be covering, a few slides down, there has been muted revenue performance, which is, I'll be covering the various key segments and the key sectors which have not performed. But the muted corporate earnings have had a very low anemic revenue performance for us. Pick up in local advertising, even as national advertising growth remains elusive. So this is one welcome trend that we have seen in this quarter. The local advertising has started coming back, though the big ticket key accounts national advertising is still elusive. What we have been guiding, all the analysts and various other people who are tracking us, is that the newsprint prices are slated to go up, which is now playing out. Though on the print side, what I can tell you is, we are still consuming some of the lower cost inventory which we had procured earlier, but we are running it down very sharply. So newsprint prices have had a very sharp impact on the cost structures of both Hindi and English publications. If we just switch gears and come to the radio business, we can see that radio business continues to be on a path of healthy growth. You've already seen the numbers, and we will be going through the financial statements. And the margin has also, got a positive flip because of the operating leverage which has flown through the radio business. Moving forward, a quick summary of the financials for the quarter. Operating revenues degrew by 7%, came out at 542 crores as against 584 crores last year. Operating EBITDA again came down from 70 to 36, and the margins as a consequence came down to 7%. PAT came down very sharply to 6 crores, and margins again came down to 1%. Net cash, however, remains to be healthy, which is still about 1,200 plus odd crores. Moving forward, the business unit performance, will be quickly taking you through the business unit performance. So first, if you look at the print unit performance, the operating revenue, which I've already highlighted, is down 7% at 478%. Operating EBITDA margin is at 14%. So ad revenues, from 421 came down to 390 crores, and circulation revenue from 71 came down marginally lower to 69 crores. However, on circulation, as we had indicated in the last call, we, along with the entire industry, are taking corrective cover price actions, which have held us in good stead. But as you would understand, with the cover price actions at the industry level, copies do drop, and that has a negative impact on the revenue. Moving forward, If we just segment that into English and Hindi, and first coming to English, the degrowth in English has been much sharper than Hindi, which is at 9%, coming at 221 crores. Circulation revenue is, down about 4%, though you see the number that says it's a decimal thing. So the key revenue drivers, key sectors like real estate, e-commerce showed ad revenue growth. Education category posted muted growth. Local to local showing better results backed by yield growth. This is the point I was making earlier. However, muted ad spend in government, auto, retail, entertainment, and BFSI category, had a heavy bearing in this quarter's financials, and national spends were muted over the last year. Moving further to Hindi segment. The financial summary, I think 4% degrowth on the top line, coming at 227 crores. Operating EBITDA, therefore, coming down quite sharply to 19 crores from 51 crores same period last year, and the margins again came down very sharply to 9%. Profit after tax came in at 13 crores as against 48 crores, and PAT margins sharply declined to 6% as against 18% last year. Net cash, as you can see, still at a healthy level of 977 crores. Moving forward, this is basically the 5% and 3% on ad revenues and circulation revenues on Hindi. Just a key summary. Some key categories which have showed pickup in ad revenue includes auto, FMCG, e-commerce, and real estate. So these have been net contributors for the Hindi publication. Cover price actions, which I was alluding towards earlier, have started yielding returns, and you will see the full impact in the second quarter results, which will come in because they have been taken at various points in the first quarter. Sequential revenue growth, therefore, is a 9%. Local volumes and yields are on a growth trajectory, and again, this trend we believe will continue well into the next quarter also. Some of the drags have been national advertising, whereby there is a massive pressure on yields. That being a substantial part of the ad revenue has brought down the entire ad revenue table lower. Despite the poor base, we've hardly seen any growth trajectory of the education category, which at a point in time used to be a substantial category for us. And there have been muted ad spends in government, classified retail, medical, health, fitness, durables, and BFSI categories. Moving forward, on the last segment, radio. As I did say, there's a growth of 12%. Revenues have gone up from 42 to 47 crores, and operating EBITDA have also grown up very sharply, as you can see, from 11 to 14, which is 27 crores. You can see the operating leverage kicking in, which is basically improving the margins from 26 to 30. EBIT, therefore, comes to a 5 crore with the EBIT margin nearly doubling themselves. So real estate and auto categories led to the revenue growth in radio segment. Moving forward, as we had announced yesterday that we are entering into a proposed transaction on the radio side. I'd just like to give a few highlights of the transaction. So we are proposing a merger of Metro radio business of HTmedia with radio business of Next Media Works. This is basically the rationale for this thing is both these businesses will create a Metro-focused radio business, which will basically be probably unparalleled in competition. The reason for metro markets is that 60 to 65% of revenues are still localized in the metro market. As you would remember, even when we entered this business in phase 2 about 11 years ago, we had taken the 4 stations in metro market, and we continue to be on our strategy. And with this merger, we will take it to the next level and become probably the biggest network with a metro-facing radio business across the country. FIVA currently has been successful with this strategy, and we plan to take this further on. The merged entity will have the widest reach in the top 7 metro markets. So all the top 7 metro markets, we will have the widest reach clearly with a lot of depth in the biggest markets of Delhi and Bombay. This will also bring benefits to synergy, which will help in further strengthening the operating margins of the resultant entity. The consideration for this transaction is a pure equity deal. There is no cash transaction. This has been structured as a single scheme of arrangement whereby relevant businesses will be combined into one entity, which is the current listed company, Next Media Works, called NMW. The scheme of arrangement basically envisages the following. So HTmedia will be demerging all its radio businesses except Hyderabad and Uttar Pradesh, because Hyderabad, because of regulatory reasons, we can't do that because there is a regulatory lock-in, and Uttar Pradesh is does not fit into the metro strategy. So we will keep that separate, and Uttar Pradesh does have more synergies with our newspaper business, so we will house it like that. Amalgamation of HT Music and Entertainment Company with NMW. This is the one where we house our Chennai station, and demerger of the FM radio business of Next Radio Limited into NMW. NMW in turn will issue shares as consideration for the above business transfer to the respective entities. Post-transaction holding, consequent to the implementation of the proposed transaction, HTmedia and its shareholder will hold 74% of the equity share capital of NMW, while current shareholders of NRL and NMW will hold the balance 26%. So that will be the resultant thing. Obviously, all these things are subject to regulatory approvals, which we are in various stages of applying for, and this transaction, therefore, will take its own time of 12 to 18 months to fructify. With that, I come to the end of a quick presentation, and we would now open it to Q&A. So if there are any questions, we would love to answer those.
Sure, thank you very much. We will now begin the question and answer session. Participants who wish to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Vivekanand Subramanian from Ambit Capital. Please go ahead.
Hi. Thanks for the call. I have a couple of questions pertaining to your decision to expand in radio. Can you help us understand the newly merged entity, which will be called Next Media Works? Is the understanding correct that the market cap of this entity, assuming that the Next Media Works share price is representative, would be around 800 crores. Is that understanding correct? And can you just briefly help us with the FY18 key financials, revenue, EBITDA, PAT, and net debt of this entity? And on a related note, can you help us understand the shareholding pattern? You said 74 and 26, but can you drill down a bit further on what will be the holding of the HTmedia promoters, the Ansari family, HTmedia and Next Media Works minority shareholders? What will be the shareholding pattern like? And lastly, on the radio business, we would like to understand, I would like to understand why you feel having a metro-centric FM radio network is with 2 to 3 stations, possibly 1 station in English in the 3 markets, makes more sense than having a greater distribution of your of the radio network. Thank you.
Thanks, Vivekanand. Thanks for that very elaborate question. Let me try to answer a few in the order that you had asked for. About the market cap, what I would suggest is, you cannot take the current market cap and extrapolate that. What's going to happen is, with this metro-centric radio station, the way, we would ideally like to see this thing is that the market currently valuing it at a comparables of other listed radio companies, and anywhere between 20, 25 times to 30 times EBITDA will be the fair value which will come out. The current market cap of Next Media Works, I don't think will be representative, but it's a forward-looking question and I can only conjecture at best. But with the strategy that we have and the stations which we are bringing into the resultant entity, I think the market multiples will be much more superior, and those are only reflecting the quality of earnings on a sustained basis, as you can see in our stations over time. Coming, therefore, to the rationale, I think, let me clearly articulate this. If you just interpolate HTmedia's radio business from a segment accounts over the last 3-4 years, you can see we've been riding a superior margin structure, because the quality of revenue and the yields of revenue in metro markets, we believe, and which has been validated now over the last 3-4 years, is much superior to the smaller markets, whereby the value creation is not that sharp. Now, having 3 stations in Delhi and Bombay, I think will give us the widest depth, which, currently no one has. Even today, we have 2 stations in Delhi and Bombay, and the next competition only has 1 in one of these markets, but we will have 3 each. the way we have segmented our current business between retro and contemporary Hindi Bollywood music, and the way Next Media Works is positioned in the market on Western music in these markets, the resultant platform gives us a lot of flexibility to look at the relevant platforms in these two big markets. Of course, there is a Bangalore and a Chennai and other markets like Pune, etc., which will now be, and Hyderabad, which will be eventually very, very interesting for these markets. But the variety that we will have on the platform, we believe, will help us drive synergistic revenue benefits, which will definitely give us superior margins. With that rationale, we progressed on this thing. As far as the drill down on the shareholding structure is concerned, what I can tell you is we went through all the possible structures that could have been to get the desired results, and we have come down to the current swap ratio, which we have kind of agreed upon. The details I would at this point in time not be able to give you, because we will be doing a follow-up board meeting in a couple of weeks' time, whereby we will be applying for all the regulatory approvals, and it will all come out there. But suffice to say that HT shareholders and HT will hold 74%, and NNW or Radio 1 and their shareholders will be holding 26%. The considerations for us on the capital structure clearly were regulatory considerations, the tax considerations, and the resultant value creation considerations, which have gone in for carving out the capital structure. That is all that I can tell you at this point in time.
Right. This was very, very helpful. Just one or two small follow-ups. The structure you mentioned, HT shareholders plus HTmedia promoters will hold 74%. So this merged entity, will it have 100% of Next Radio Limited, or will it have 51% of Next Radio? Because currently Next Media Works has 51% stake in Next Radio, which runs the 7 Radio 1 stations. I'm sorry if the question is very basic in nature. I can understand. I think we've just announced the scheme yesterday. It will have 100% of the operating radio businesses of Next Media Works. However, Ahmedabad will not form part of that scheme, because Next Media Works, even before the inception of the scheme, had demerged that into a separate legal entity and had applied to MIB for separate approval. So all their businesses, except Ahmedabad station, will be part of the resultant entity, which is distributed in the ratio 74-26. And it, one of the things you mentioned is the promoters, etc. It's not promoters, it's HTmedia and the shareholders on one hand, having 74, and Next Media Works and their shareholders on the other hand. That is the capital structure, which will be the resultant capital structure. So lastly, just to understand clearly, you are saying that the Ansari family will no longer be the promoter of this entity, is it? It's just the HT promoters that will promote this company, hosting HT's radio stations, metro radio stations ex Hyderabad, and the Next Media Works stations, Radio 1 stations excluding Ahmedabad.
Yeah, no, your understanding is fair. Presupposing that all the regulatory approvals come in that fashion, that will exactly be the way it will play out.
Absolutely, yeah. Assuming all that, yes.
Yes.
Thanks a lot. I have some more questions. I'll come back in the queue.
Thank you. Before we take the next question, we'd like to inform participants that in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. The next question is from the line of Giriraj Daga from KM Visaria Family Trust. Please go ahead.
Hello, Tim. My first question related to what is the amount of debt which will be transferred along with radio business?
So in this scheme, HT is not transferring any debt. However, there's a 47 crores or the closing number of 31st March is the debt which is being passed on from Next Media Works.
So, sorry, the amount of debt from HTmedia will not be transferred apart from the 47 crore?
No. HTmedia is not transferring any debt. However, in this amalgamation scheme, the Next Media Works is transferring their closing debt on 31st of March. Balance sheet, because we've used that balance sheet to create this amalgamation scheme.
Okay. But that's the thought process. Why? Like, because we had the last capex was actually done on the radio side where we had to pay significant amount for this frequencies. So we are not transferring any of the debt?
You answer that. Go ahead.
So the radio business, all these stations have become cash generating. They don't need any financing per se. So in the envisaged transaction, we are not transferring any debt.
Okay, and when I had to look at the numbers of radio business, X of UP and Hyderabad, what would be the normal like-to-like number?
We've disclosed that in the filings. You could just probably pick it up from there.
Okay, if you can say broad percentage, like last year we did a 178 crore. So how much would have been a UP and Hyderabad put together? Out of revenue number?
So what is on the revenue number, what's the contribution of UP and Hyderabad? It's a very minuscule number right now. We won't be able to give it to you, but I can tell you it's a very minuscule number because UP, a couple of things I'd like to make. UP was the late operationalization of the license that we did, and the whole thesis of buying UP station was a synergistic benefit with our Hindi publication. So
okay.
That's how it's going to grow eventually. And Hyderabad currently is a very small number, but because of regulatory things, it's in a lock-in, and that will not be part of the scheme.
Okay. My second question is on the print side of it. Like last 2 quarters, we are talking about a change in strategy, focusing on yield. So do you think that we are moving on the right direction so far, and there is no rethought on the strategy so far?
Yes, our strategy on the yield remains intact. However, given the market scenarios and the competitive pressures which are there because of competitive behavior, we are trying the best we possibly can, as I had shared in the presentation earlier. On the local side, we have got some early successes, but on the national side, the needle still has to move quite a lot. And in spite of the fact that we do have a strategy, we still have to, on the national side, taste early success. But on the local side, I think the strategy is well on track.
Okay. My last question. On the cash side of HMVL, this quarter it's 977 crore versus 1061 crore on the fourth quarter number. So there's a drawdown of some about 85 crore. And if I add the PAT, so there's roughly a drawdown of about 100 crore in cash on the HMVL side. If you can give the breakup of that.
It's largely working capital investment.
See, basically, with this newsprint scenario, we are trying to upstock newsprint and working capital, including receivables, which typically tend to dip in March, tend to go up in June. So it's primarily working capital.
Thank you. The next question is from the line of Yogesh Kirve from B&K Securities. Please go ahead.
Yeah, thanks for the opportunity. This is on the radio transaction. So if I get my understanding right, the HTML shareholders and HTML will together get about 37% stake each in NMW. So is that the correct assessment?
As Piyush mentioned in his earlier comments, given that we are in the process of finalizing the scheme documentation and that is going to be approved in the subsequent board meeting, we would like to defer this question at this point of time. All the details will be announced to the public, and we can possibly address this once the scheme is also final.
So we have already announced sort of this swap ratios. Right. So are you saying that this could be revised or this could be...
No, this will not be revised. The whole point is, there are some regulatory filings which have to be done. We have already announced that, but the regulatory filings are happening now. But broadly what you're saying is between the shareholders of HTmedia and HTmedia, there is a 74% chunk which is distributed there. But we'd like to do our filings and then in the scheme kind of capture that, but I don't think it's going to be changed. But that's basically what it is. But we'll be able to disclose it in the filing documents a couple of weeks from now.
Okay. And justly, if you look at from the HTML shareholders, both the minority as well as the promoters, wouldn't it be ideal that they would have a direct exposure to NMW instead of sort of an indirect exposure to HTmedia as well? So could we envisage a transaction where HTmedia shareholders will get direct exposure to NMW?
As I was explaining to the gentleman before you on this thing, we had evaluated all the possible structures, and 2 or 3 guiding principles were there. Obviously, the regulatory approval was the one that we were, was paramount. because this is a very heavily regulated sector. The value distribution between both the merging parties was clearly the one which was the lighthouse on this whole stuff. And the tax was the last consideration that we were basically working on. Now, whether it will be a direct or an indirect is a consequence of what best we have been able to achieve in this scheme of arrangement. But I can tell you there's partly direct and partly indirect, and 100% direct exposure, was not working viable, and that is not the way it has been achieved. This I can tell you at this point in time.
Okay. So secondly, in terms of your print advertisement revenue growth, especially in the Hindi side of the business, so I think the advertisement revenues were down by about 5%, 6%. So what's the outlook? So first of all, what is the weakness during this particular quarter, given that the base was also quite low? And how do we expect FY19 to play out based on the way it has started?
Look, this particular quarter, the setback has largely been one government advertising. Last year, this quarter, on account of the GST implementation, the government expenditure was reasonably high, especially in the month of June. So that is one particular segment which is lower. The second is not all the national advertising categories are firing still. There is some recovery. Piyush mentioned earlier. FMCG categories advertising has grown very well. Automobile has done well, but however, some of the other national advertising categories have not done that very well in April-June quarter. But the largest contributor is the slowdown in government spending in April-June quarter. So that's as far as April to June is concerned. However, the good part is, as Piyush mentioned again, the local retail advertising seems to be picking up. There is some buoyancy which we are seeing in real estate and other local advertising. Going forward, look, as I said, in the Hindi part of the business, the government advertising is one of the largest contributors. Going forward, we are quite buoyant about that particular expenditure, largely on account of the impending elections. So I would say it's more of a phasing thing. So we remain upbeat about government spending this particular year.
Okay, so if we can...
sorry to interrupt you, Mr. Qtr1, but may we request you to return to the question queue for follow-up questions, as there are several participants waiting for the turn. Thank you. The next question is from the line of Vaibhav Vajatia from HNI Investment. Please go ahead.
Hi, sir. Thanks for providing me this opportunity. I have few clarification on the the digital content business that is going to be listed separately. So, first of all, any timeline on that, and second, on the shareholding of the company that's going to list. So, will the HTmedia public and the shareholders of HTmedia would be the promoters of HTmedia would be the shareholders, or is just the promoters of HTmedia and the public would be the shareholders?
Okay, so just we have got the shareholder approval for the scheme, which is why it is now disclosed as a discontinued operations in the financials. Now we are awaiting the final approvals from the NCLT, so it is a function of how long they will take, but so it could anywhere be about 3 to 6 months for the final closure on this. In terms of the ultimate shareholding, it is the shareholders of HTmedia who will be shareholders in this entity going forward.
Okay, so HTmedia will not have any stake directly into that new listed company. That's what you meant to?
Yes, that's right. That's how we've always conveyed also from the time the scheme was announced.
Okay. And secondly, on this newsprint prices. So, I understand that, partly the newsprint prices is due to some of the, pollution-related controls that has been implemented in China. So, I just want to understand that what do you think that how sustainable it is, and because we have seen in a couple of other chemicals where, this has turned out to be a sustainable level for the prices of those chemicals that China has acted up. So, if this turns out to be sustainable rather than temporary, then what would be the strategy going forward?
well, it's very tough to comment on whether it will be a sustainable regulatory shift in China or not. But personally, from the other side, if you view this thing, I personally don't believe that this can be sustainable because, at these escalated raw material costs, the whole sector's viability will come under question. So I don't think it will be sustainable because at this price, there will be a lot of merit for a lot of new capacity to come on stream. And this is not a viable price level for raw material for this sector, and it will totally take away the viability. So as you can also understand, this quarter there's been a double whammy because also the currency has moved very sharply in a 3-month period, not just the commodity prices. So I think the commodity prices will correct. Even if China's regulatory requirements remain where they are, I think new capacity will come on stream. And as far as the currency is concerned, it's anyone's guess. I mean, that's a $1 million question we can't answer. But I personally believe that the prices are at a very high level now, but stable. They're not going up any further. Time will tell where they will go, but I personally believe that at least in the next 2-3 quarters, they should start coming down.
Thank you. The next question is from the line of Vikas Mantri from ICICI Securities. Please go ahead.
Good morning, everybody. Just wanted to understand, in all the radio stations that will be there in the new entity, the stakes will be 100% or not? And second is, can you help us with what is the current realized cost, or if you were to use the current realized cost of newsprint, what could be the further increase in newsprint or raw material that we have?
Because it is not a station-wise purchase. It is that all the radio stations are getting transferred to one legal entity, in which the holding will be 74:26. So to that extent, all the metro stations, the 7 from ST and the 6 from their side, will all come in one legal entity, and it will be that entity in which the holding will be 74:26. So it can't be 100% in any station in that manner. And secondly, on your newsprint question, as Piyush had alluded to during his comments, we did have some lower cost inventory which we had kind of utilized this quarter. So the full hit of the newsprint spike has not come in quarter 1, and therefore quarter 2 will see a increase in rates over and above the current quarter as well.
Can you help us with the realized cost in this quarter versus the realized cost of our inventory?
We don't give the absolute number, but it will be about 7 to 10% over the current quarter number.
Okay, thank you.
Thank you. Next question is from the line of Arpit Ranka from Koval Investments. Please go ahead.
Yeah, hi. Morning. I have a couple of questions. So the first one is, as part of the scheme, HT Music and Entertainment, we had infused, say, 400 crores into that subsidiary last month. And that entity will be issued, let's say, around about 18 crore shares out of 50 crore shares eventually in the next media. It is a 35% stake, and that subsidiary only has Chennai license other than that 400 crores. So is it safe to assume that that 400 crores is getting transferred to the combined entity?
Yeah, so first of all, one factual correction I'd like to do. The facilitation that we had taken in the board resolution was 400 crores, but we've not infused 400, we've infused 300 crores there. So the total infusion in HT Music, where the Chennai license is housed, is 300 crores. But the rest of the argument, what you're saying is correct. That we had evaluated from the best capital structure point of view, from tax regulatory and shareholder value creation point of view. So that is exactly how you're saying. Exact number of shares, I don't have readily, which I can't say, tell it to you.
Okay, no, that helps. Thanks a lot. And secondly, of the radio stations which are getting demerged, you've given a sales number of, say, 158 crores out of 178. What is the approximate cash flow or EBITDA on this, on these stations? If you just give a ballpark number, that would be helpful.
See, all our stations are profitable. So, I mean, and the largest, EBITDA profitable, and the largest is largely the metro stations, which anyway contribute to the profit. So I don't want to give an absolute number, but indicatively, most of the EBITDA numbers is from the metro stations.
Okay, thanks a lot. That's helpful. Good luck to you.
Thank you very much. The next question is from the line of Jigar Shah from Maybank. Please go ahead.
Yeah, hello. Good morning. My question pertains to the segmental profit and loss for this quarter. I think the unallocated shows that there is an increase in the losses from 28 crores in first quarter of last year to 39 crores in first quarter of this year. So can you give some more light on this?
Hi, Jigar. Yes, the unallocated cost, we took mark-to-market losses on some of the investments that we are holding. That cost is in unallocated, and that is why you're seeing a spike. Last quarter, actually, on some of those, I had booked a fairly high MTM gain, and then there was some correction in prices, because of which I have MTM losses this quarter.
So are these some mutual fund investments, or these are some other investments?
Strategic investments.
Strategic investments. And can one say that this is something which will not repeat in the subsequent quarters?
See, as long as we hold the investments, it's subject to market fluctuations and market risk. We do, of course, opportunistically book profits and profits on this thing also. But given as long as there is a market fluctuation, it could potentially happen.
Okay. And on the, were there any other one-offs in your P&L in this quarter?
In the other, we do have it in the salaries, because there has been a one-time truing up of certain bonus provisions that are there.
Could you quantify?
No.
Okay. Is it big, small?
Well, it's a big number. Those were the year-end bonus provisions which were quantified after the end of the year. That's a big number, but that's a one-off year.
Okay, and one last thing is, on other income, we have seen a sharp fall, while you have suggested that your cash levels at the console level are still marginally better than what they were. So would like to understand, the trajectory of other income for the full year and in the coming quarters, if you can give some better idea about it.
So the drop in other income will be just a reflection of the yield curve. So if the 10-year GSEC had increased by about 50 bits from the March 31st position to June 30, which was a sharp increase over one quarter, on account of which we took some hit even on the interest income side. However, going forward, the accrual will be on such higher rates, and therefore on a full year basis, there will not be any problem.
Okay, that's it. I think the rest of the questions have been asked, so I will not repeat. Thank you.
Thank you.
Thank you. Next question is from the line of Rohit Dokania from IDFC Securities. Please go ahead.
Yeah, hi, good morning. Just two questions from my side. One is basically on the discontinued operation side. So in your notes to accounts to consolidated results in point number 5, you were saying that pending the requisite approval, impact of the scheme is not considered in the above results. However, there is the discontinued operation. Could you please clarify what exactly it is?
So, given that we have received the shareholder approval for the scheme, we were obligated to show this as discontinued operations and disclose the results as a separate line. However, since the final approval is subject to getting the NCLT clearance, etc., it is not that post the final approval, this entire business will actually go out of the entity. So it has not gone out of the entity at this point of time. However, because the shareholder approval has been received, we are required to report it as a discontinued operation. So that's the sum and substance of it.
So, yeah, understood. So this is basically the multimedia content management business that we have been talking about all this while.
Plus some other digital businesses also.
Yeah. So Anna, if I look at the FY18 sort of segmental that we had sort of reported, the quarterly run rate of the MCM segment was in the range of about 45 odd crores. And here in discontinued operation, the quarterly run rate is about 9 crores, and again, the year-end number is just about 26 crores. So could you please help me reconcile that?
While there is a little bit accounting related factor playing here, so while the continuing operations reflect the performance and what it will be on going forward of the continuing operations, the discontinuing operation numbers are kind of reported as what is a consolidated less the continued operation. So it's not a true reflection of the continued operations going forward, and it will have an impact of intercompany adjustments, etc.
But the difference could be so huge from 26 crores to 200 crores. That's like 90%, shortfall.
There are cross charges also, in MMCMD division.
Okay, fair enough. I think I'll take this offline. The other question that I had is that, so now basically, post this radio sort of, bulk of the radio rather sort of moving out. So essentially HTmedia now is sort of a pure play print player, right? That's how it is, because most of the digital has been moved out in terms of, this MCM, and then radio has also been moved out. So obviously HTmedia will hold some part, probably in the range of 37-38% in this radio entity. But otherwise, we are now probably a pure play print player. That's what, it has now become, right?
Yeah, your understanding is absolutely spot on.
So wouldn't that sort of, hurt our, medium to long-term prospects? Because, earlier when these two businesses were also part of the sort of console entity, it was a far better place in terms of, both sort of a mix of traditional and future mediums. But now we are sort of left with just a traditional medium.
I think it's a very hypothetical question. I mean, you have seen the HTmedia's share performance and the business performance over various digital media businesses that we've tried to incubate, and also radio businesses, the way it was in 2008, 9, 10, etc., and thereafter. Now, how these businesses will eventually perform, I mean, digital, we all know, is the future. So digital is impacting not just the print media businesses or just the media businesses, but other forms of businesses as well. But the structuring for us, the way we have kept it is a subset of the larger business synergy and the business. How do you run the business to harness the synergies out of this? As I explained last time, when we had our investors at IDFC's meeting, we have created a separate digital team with a separate plan, with a separate objective, and they are scoping out the market and trying to set up their annual operating plan in that era. Now, whichever legal structure works best for us, we are going for that. Similarly, for radio, now that it has gained a certain level of scale and size, we are unlocking it and basically putting it into a pure play radio operation. The HTmedia, of course, has its headwinds, etc. currently for the last 6 to 8 quarters. And it's foolhardy to say that how the future will be. But it will be a pure play company. So rather than just looking at from perspective whether this play will be more interesting because of different media platforms, it's better to set up a business in a manner whereby it is set up for success and the values will follow thereafter. So that's the paradigm that we are going after. Of course, only time will tell how it plays out.
Obviously, okay, that's fine. Just one last question from my side. So if I got you right, you're saying the sort of radio entity would have about 47 odd crores of debt which moves from NRL, and about 300 crores of cash that will move from HTM. So the net cash out there would be about 250 crores. Is that a fair understanding?
No, Rohit, the net debt from the HT side will be zero because there is debt sitting in the radio undertaking and there is cash sitting in the downstream entity. So that the net debt position for the radio business will be zero on the existing, and then whatever is in the LRL balance sheet will come to the joint entity.
Understood. That's very helpful. Thanks a lot.
Thank you. Next question is from the line of Rajiv Bharti from India Nivesh. Please go ahead.
Thanks for the opportunity. Sir, in terms of cost synergies, once you have, let's say, 3 stations in Mumbai, 3 stations in Delhi, 2 each in Bangalore, Kolkata, Chennai, do you think you can bring down the cost? Because as per the last numbers, if you add 47 crore for the depreciation of your frequencies plus 20 odd crores for what EBIT number you report, 70 crore on 162 crore number, what you have mentioned on the revenue side for the demerged piece, 43% kind of margin you make, EBITDA margin, versus maybe 25 for Next Media. Is there a potential that Next Media's margin can be scaled up to your levels?
I think that is definitely one of the rationales rationales because of which we are going ahead with this merger. And, that's actually a very, very critical reason for us to go down this route. The reason we are very, very confident that it will play out is, even when we launched our own Radio Nasha stations in Delhi and Bombay, we've seen the cost synergies playing out very sharply. So I see no reason why in this merger they'll not play out. We will get the same advantage. Now, how much time that will take? Will it play out over a quarter or 2 quarters? Will it take 4 quarters? Is only time will tell. But for sure they will play out.
Yeah, and in terms of, let's say, rebranding, whether you will going to change the genre as well, in the sense
all those discussions are for the future. Yeah, we will definitely do what is best for this combined network. But as I said, cities like Delhi, Bombay, Bangalore are metropolis whereby there is a demand for different kind of genres. We've already seen that demand playing out for Radio Nasha, which is retro Hindi Bollywood music, and we are seeing already a good performance. I mean, I have guided you in the last call that Radio Nasha actually started with yield realizations better than Fever, in spite of the 10-year legacy that Fever enjoyed in the market of Bombay. So genres, branding, etc. are all the things that we will look at a future date. At this point in time, these are independent businesses, and they continue exactly in the same fashion that they were continuing before this transaction was announced.
Yeah, so just one last question. So, though this question is more for the Next Media management, so now they are only left with one frequencies. I don't understand that they will be continuing that. So you could have bought that as well, right? I mean, why leave Ahmedabad alone?
I think this is for the Next Media management only, and I think we can't comment on that. There might be a strategic play. They must have thought about it.
On the one, the thing Piyush had already commented that there is an existing scheme that they have, which their entity is subject to. So the rest of the details they will be able to share. It's not part of our deal with them.
Sure. Thanks a lot.
Thank you. The next question is from the line of Naitik Modi from OHM Portfolio. Please go ahead.
Sir, could you please tell us what is the value that you've attributed for the Next Media radio channel?
I think on the valuation, I guided one of your colleagues earlier. We use comparable valuation methodology of both the listed radio stations and use that for arriving at a resultant valuation.
So what is that value?
The final value is a function of what the valuer has come as a swap ratio, which is 74:26 we have reported. But of course, the market multiples and the synergies that we will derive from the business going forward were the guiding principles.
No, I'm looking at a value that the company has attributed for buying the Next Media radio channel.
We are not commenting on that.
Okay, thank you.
Thank you. Next question is from the line of Amit M. from RoboCap. Please go ahead.
Hi, good morning. Thanks for the opportunity. My question is about newsprint prices. Can you please quantify how much it has gone up on metric ton basis year on year and quarter on quarter?
Year on year, it is about a 15%, and sequentially also it's about that number.
And in rupee terms, what exactly is that number?
Sorry?
In the rupees, like if I have to quantify in rupees, what would that number be like?
About 6,000 rupees per metric ton.
Okay, thanks. And do we buy it locally or do we import it?
Combination of both.
Okay, thanks.
Thank you. The next question is from the line of Venkatesh Varan from Trustline Portfolio Management.
Yeah, good morning. Hello, good morning.
Good morning.
Yeah, I didn't catch the price per metric ton of the cost Madam was saying. Newsprint cost.
Yeah, so currently the price per metric ton is about 42,000 rupees a metric ton. And what Anna was alluding towards is both sequentially and versus the same period last year, it's gone up by about 6,000 rupees a metric ton. The replacement price, however, which will come into the P&L in the next quarter, might see a sharper escalation because we were still, consuming inventory which had been purchased at a price which was less than 42,000 a metric ton.
Yeah, thank you, sir. Thank you, sir. One more clarification regarding Digi content demerger. So Digi content will be 100%, HT Digital Ventures will be 100% subsidiary of Digi content post demerger?
That's right.
So HT DTV's FY19 revenue was around INR 230 crores.
What is the question?
HT Digital Ventures FY17 revenue was around INR 230 crores.
I don't immediately have the number, so the question being?
Ma'am, FY17 HT Digital Ventures revenue, ma'am.
Are you checking? I wouldn't have the number. FY17 revenue is upfront here. We'll have to take it offline.
Okay. That's it, ma'am.
Thank you. Next question is from Rishi Goswami from Locus Investments. Please go ahead.
Hi. Just a clarification on the transaction. Could you please clarify the shareholding structure of NWL post the transaction? How much will be owned by HTmedia directly and how much will be owned by HTmedia shareholders?
As I was alluding earlier, we are not going into the details of the capital structure but HTmedia shareholders and HTmedia will be jointly owning 74% in the resultant entity, and the balance 26% will be Next Media Works shareholder and Next Media Works themselves. The structure for both the shareholders, the majority and the minority, will be direct and indirect exposure to Next Media Works. The way we have carved out the capital structure, and I was guiding earlier that the considerations have been regulatory, economic value creation, and taxation reasons. The current structure that we have formulated.
Right, but the structure that you have formulated, I guess, is a final structure, right? So why is it that you are not sharing?
It is the final structure, but it is subject to approval. So we don't undersee any changes happening there. But all these things will be put into a public domain in the next couple of weeks when we put out the scheme document. And before all the regulatory approvals are filed, we wouldn't like to kind of venture into that area right now.
Okay, then so as a shareholder of HTmedia, we do get some shares in NWL.
Yes, absolutely. I mean, some you get directly and some obviously you get indirectly through HTmedia, but absolutely you do.
Okay, thank you. That's all.
You are.
Thank you. Next question is from the line of Nath Balakrishnan from Spark Fund. Please go ahead.
Yeah, hi. Thanks for the opportunity. Our questions are pertaining to HMVL. I think, firstly, if you could just help us with an understanding of the competitive landscape in your key markets, Bihar, Jharkhand, and UP, and help us understand, how you are positioned vis-a-vis competition there. The second question is on, can I just finish?
Yeah.
Yeah, and the second question is, essentially wanting to understand movement in raw material prices. While we do gather that you say that, prices that are prevailing today are 42,000 rupees a metric ton. What we'd like to understand is, what was that cost on your P&L for the first quarter? And what is the inventory that you are carrying currently in terms of, how many months would you be covered?
No, I won't be able to share that level of details with you. So I will just let Qtr ask the first part of the question that you had.
Okay. As far as the competitive landscape is concerned, in the last, there has not been too much of relative change in the last 3 to 4 months. In fact, I think in one of the earlier sections we mentioned that practically all players are currently undertaking some cover price increase actions. Recently in the last call we had mentioned the IRS results had come out after 4 years. Sometime in January, February, we fared very well in the overall readership survey. So Hindustan is the second largest read daily in the country overall, and we continue to be dominant in overall Bihar and Jharkhand put together, and UP also, UP Uttarakhand put together. We have become number 2 in our readership. So that's our current status vis-a-vis competition. So we are reasonably well placed. From, as I said, the relative competitive scenario, not much has changed in the last 3 to 4 months. In fact, at this point in time, mostly, one is witnessing some stability, actually, some stabilization, some cover price actions are being undertaken. So we continue to lead significantly in Bihar and Jharkhand, and in UP we are overall a number 2 right now. Not too much of relative change in the last 2, 3, 4 months. One thing that we have done though is we've launched a new Purnia edition in April with an intention of having a stronger presence in Bihar. So that happened in April, which will further strengthen our position.
Okay, thanks. Anna, I appreciate you not wanting to disclose more granular details on inventory, but in response to an earlier question, were you commenting that you expect an escalation of a further 7 to 10% on raw material prices?
That's right.
And over how many quarters will this be?
The next 2 quarters for sure. After that, there should hopefully be a downward decline.
Okay. And can you also help us, with some color on, the movement in the other expense categories on your P&L? For example, I know you did mention there's a one-off component on employee cost.
Yes.
So do you see that trending back to levels that you saw in Q4?
Definitely.
Give or take,
Give or take some corrections, because there would have been some impact of increments also. But apart from that, yes, the Q4 will largely be more indicative of the trend.
And what about your comment, your outlook on the other expenses line? Because that's seen a fairly sharp jump of about close to 15%. And what would you attribute that to? And
mark-to-market losses that I mentioned, which is sitting in unallocated cost, that forms part of other expenses in the main P&L.
Okay. So and can you quantify that, Anna?
No, I wouldn't want to do that. But it's a substantial number. It's a double-digit number.
Okay. And so, but you're not netting off any mark-to-market losses on your other income line, is it? On account of...
Interest income gets reported separately. This is the MTM gains on the strategic investment, which comes in this line.
Okay.
Thank you. The next question is from the line of Ankit Kedia from Centrum Broking. Please go ahead.
Just on the radio deal, given that the shareholding will change substantially and the promoters would change, would this have a trigger an open offer in the future?
Because we are doing the entire transaction is through a scheme. Under the takeover code, when the transaction is through the scheme, since all the relevant stakeholder approvals are required, there is no requirement of an open offer.
Sure. And would you be able to share some financials on Next Media's EBITDA number? While it's around 10-11 crores, how much would Ahmedabad contribute?
No, we can't get into such granular level of details, I'm sorry.
Sure. Thank you.
Thank you. The next question is from Shobit Singhal from Anand Rathi. Please go ahead.
Just one clarity. The company effectively not transferring net cash into NML, right? As you are putting 300 crores into the Chennai subsidiary. But it does also have debt in that?
No, the business in under business from which is demerging from HTmedia has debt, and therefore the net position will be zero.
Okay. Thank you.
Thank you. The next question is from the line of Shalak Agarwal from Slowball Capital. Please go ahead.
Yeah, good morning everyone. Thank you for giving me this opportunity. The first one is on, HMDL. If you can tell us what is the level of inventory and debtors on the balance sheet at the end of the first quarter?
I have already conveyed that we can't get into such granular level of details, please.
This is just some balance sheet, numbers that we are asking.
Yeah, I know, but we can't share it at this point of time. It's not, balance sheet is not published.
Okay. The second question is, on the education business which was getting merged with HMVL. Just wanted to check this Bridge Management School. Is it part of this education business?
Bridge is the part of the business that is getting transferred.
So that will become part of HMVL?
Yes.
Okay. That helps. Thank you.
Thank you. The next question is from Rishabh Seth from Karma Capital. Please go ahead.
Hello. Hi, Piyush. This is Rishabh here from Karma Capital. This is just one, after hearing and looking at this demerger of radio, one feedback from my end was that, you've demerging the digital and you're giving shares to all the shareholders. Why? And completely in the proportion of whatever they hold. Why not in radio? I mean, we can't, from whatever that I've heard today, I can't understand why the same thing couldn't have been done with the radio business.
Sorry, I missed the point here. Why that couldn't have been done in the radio business? Meaning, can you just...
Yeah, exactly. So why should HTmedia be holding a part of the radio business, unlike in the digital demerger, where you are, giving shares to all existing shareholders of HTmedia? The same thing could have been done that, shares should have been given to all the existing shareholders. All the radio shares should have been given to all the existing shareholders of radio media.
I think I think I got your question.
It's just a feedback, from our end, because I think, from all these years, we have not seen much value creation from the company. This is an opportunity for shareholders to participate in the radio business. And by keeping some shares of radio in HTmedia, you are neither creating value in HTmedia nor you are allowing the full value to be, accrued to the shareholders of the new company.
Well, this latter part of the question, I totally take your feedback on board and I'll definitely pass it on. But the first part of your question, which was the comparison on the digital scheme and this scheme, I think the relevant reason and the factor driving that difference was that this is a regulated sector that is not. So here the considerations were regulatory, tax, and achieving the economic value swap ratio. Whereas those considerations were not there. So I think on the comparison, those are very, very clearly very, very different things. But the latter part, I totally hear your feedback, and I've taken a note on that. I totally hear what you're saying.
Yeah, so it'll be, we really appreciate if you can take it to the board and if suggest that if that can be done, it'll be really in the interest of all the shareholders of HTmedia. It's not going to do injustice to any part of the shareholders of HTmedia if you actually do exactly what you're doing in HT Digital. If you are able to do it from a regulatory perspective, if you're able to do it for the radio business as well.
Yeah, I'll definitely convey your thoughts to the board, but as I said earlier, one is a point whereby you're saying, the shareholder should be given direct shares of the radio business so that the unlocking can happen. That's one part. But on the comparison, I'd again repeat, it cannot happen like digital for reasons which are very different because two schemes are very, very different. One sector is regulated, the other is not. One has a joint venture partner, other is not a joint venture, a merger partner, other has not. And, there are operating businesses. So, those schemes cannot be mirrored in each other. But I totally take your point of view and which I'm definitely going to take to the board.
All right. Thanks. Really appreciate that. Thanks a lot.
Thank you.
Thank you. The next question is from Ankit Sonkia from Oculus Capital Advisors. Please go ahead.
Thank you, sir, for taking my question. The resultant entity of radio, how much net debt will it have after this scheme? And also, if you can tell me the current EBITDA level that I see for HTmedia from the radio is approximately 14 crores for this quarter. So will this, the resultant entity, will that have a higher EBITDA?
No, the net debt question, I understood. The second question, unfortunately, I missed. What is the second question, please?
Second question is, what will be the increment to the EBITDA level when we will combine these entities compared to HTmedia's current EBITDA from radio?
Okay. On the debt side, as I said earlier, HTmedia's contribution to the resultant entity is a neutral position. So no cash and no debt. It's just the March ending debt of Next Media Works, which is coming into the resultant entity. So the number is 47 crores. I've already given you that. As far as the EBITDA is concerned, both are in the public domain. I mean, you can pick it up, but going forward, first, we don't give any going forward statement, but it suffices to say that our strategy by combining both these businesses is to create a very big synergistic effect, one on the cost side, and secondly, with the depth in the 2 or 3 big markets of Delhi, Bombay and Bangalore, be able to drive the synergy on, various things, including sales, etc., on the front-end side in these big markets. So I personally believe, because in the current scheme, when we were discussing with our partners on the economic sharing formula, we have not taken the synergistic benefits, but I believe the synergistic benefits would be quite a lot. And the reason I say that with conviction is on the cost side, we have clearly seen synergies even when we launched Radio Nasha 2.5 years ago. So I presume for a running operation like Next Media Works, with a good brand that they control in these markets with different formats that they play between English and Hindi, I think we'll be able to drive synergistic benefits. So my point is, the whole would definitely be, let's say, 12, 18 months when the deal is complete. After that, the first full year, I think the whole will be much bigger than the sum of parts, very clearly.
Okay, perfect. Thank you. And what will be the net debt of HTmedia after this scheme?
Of HTmedia?
Will it remain the same? Yes.
Well, the HTmedia net debt is a
nothing, on a consolidated basis, nothing will change, no?
Nothing will change. Okay, thanks.
Thank you. The next question is from Rohit Dukania from IDFC Securities. Please go ahead.
Yeah, hi, morning again. I just had a continuation to the previous question, to this question. We have sort of recently spoken about putting about 302 odd crores, into the HTM subsidiary, and then we have announced this transaction right away. So I'm just wondering, what was the reason for us to do that, and why not rather sort of amalgamate Chennai into HTmedia, and then, move the entire business from a sort of HTmedia to NMW, rather than sort of first investing another 300 crores, and then letting HTmedia also hold 37% in NMW. So what was the rationale of, this putting 300 crores, which I think as of now the shares also have not been allocated, and we have also announced the transaction. What exactly led to this decision?
Well, again, multiple structures were evaluated. And the principle was, the ease of getting regulatory approvals, etc. There were some exclusions to what all stations from our side and what all stations from their side will go into the transactions. There were sensitivities and considerations which had to be managed. So that was point number 2. Tax and overall capital structure, which was acceptable to both the parties, was the last consideration. So, there could have been many structures, as you rightly pointing out, but, the current structure was the most optimum structure that we found on these considerations. Hence, we followed that structure. That is all I can tell you. And what that does is, to the shareholders, majority and minority, it gives a direct and an indirect exposure to the NMW asset, which, as, the gentleman before you was saying, he was not very happy, but, we had to take all the considerations into account, and we had taken that, but I totally take his feedback. So this is all I can tell you about the capital structure result. And
I understand. So I understand, Piyush, but I'm just wondering, which was that one particular sensibility or regulatory aspect because of which, you have, so as I said, you have not even been allocated those 300 crores worth of shares, by HTM yet. So what was that one particular...
Now I'd like to hand the conference back to Mr. Shobhit Singhal for any closing comments.
I would now like to invite the management for any closing comments if they want to give.
Well, thank you everyone for making the time to come to our call. Of course, we've announced this transaction, and I could absolutely understand the clarifications that all of you are seeking. This, we believe, is a very, strategically a very ambitious direction in which we are trying to take, company for all stakeholder value creation. The print business, of course, on both the revenue side and the commodity side is facing a bit of turbulence. We hope that, it will be short-lived, and in the next quarter or the quarter after next, we'll be able to overcome that. The company still remains very focused on its core strategy around information, education, and entertainment. And we, as you can see with this scheme, we are trying to fortify our position there. With my colleague Rajiv Biotra, the management of our print business have been synchronized into one cohesive unit, and the direction that we are taking there, is very simple. So, going forward, focus on print, focus on digital, and focus on radio will be the way that we will try to take the company. Revenue, I hope, will improve soon. Parallelly, we are trying to grow our digital business so that going forward we can reap the benefits. So I personally believe, and also the balance sheet is sound enough to finance the future ambitions. The company is currently a cash-generating company, and I hope it will remain like that. Rajiv, do you have any thoughts, comments?
No, nothing else much to add. Piyush has summarized it well. So we are looking at, there are headwinds which will certainly continue for the next couple of quarters at least. Commodity cycle will certainly come down. We are also buoyant about advertising revenues of some of our large categories, as I mentioned, especially the government revenue. We will come back there. But parallelly, we are undertaking some other structural actions to try and leverage the overall print synergies, and we are hoping to see the benefits of some of those accruing in the next 3 to 4 months' time. The good story even in this quarter has been, I would say, the circulation cover price actions and some of those other activities. And the other, of course, good action that we undertook this quarter was the local revenue. So some of the sort of encouraging facts are local revenues coming back. Circulation performance will look very, very good, hopefully, as we progress. So we are now hoping that the advertising revenue growth also comes back into our print business. Thank you very much.
Thank you all. Thank you so much.
Thank you very much. On behalf of Anand Rathi, that concludes this conference.